Welcome back to the deep dive. We're here to take a massive stack of sources, articles, research papers, financial reports, and turn them into instantly actionable, comprehensive knowledge for you.
And today, we're tackling a big one.
A huge one. It's a concept that dominates consumer finance discussions. It's often talked about as this, financial lifeline.
Right.
But it's something where very few people truly understand the fine print. We're talking about debt consolidation.
It sounds so deceptively simple, doesn't it? Just, roll all your bills into one.
Exactly.
But as our sources today really lay out, the reality is a multi-layered financial strategy. It involves some really significant trade-offs.
Trade-offs in what way?
Well, particularly when it comes to risk, to collateral, and ultimately your future fiscal health. We have sources today that not only map out the mechanics for consumers, the costs, the benefits, the structure, but they also take this fascinating turn.
Right, into the student loan piece.
Exactly. A fascinating turn into how different countries handle arguably the most complex consumer debt of all, student loans.
That's right. Our mission today is pretty comprehensive. We're going to define the core concept, unpack the whole spectrum of options available to debtors when they really hit a financial wall.
And then drill down.
And then we're going to drill down into the two main paths of consolidation. The secured route, which, usually involves your home.
Which is the scary one.
And the unsecured route. And then, like you said, we pivot sharply to this deep dive on student loan consolidation, contrasting the federal systems of the U.S., the U.K., Australia, and even Japan.
You're going to leave this knowing exactly what the stakes are.
Absolutely.
And we have to start with that foundational definition. Because, everyone talks about it, but they often miss the actual financial mechanism at its heart.
Okay, let's unpack this then.
Yeah.
Fundamentally, what are we talking about?
At its core, debt consolidation is a structured form of debt refinancing. The main action is taking out one new, usually larger loan to pay off many existing and typically smaller debts.
So it's the financial equivalent of sweeping everything off a messy kitchen counter and putting it all into one single tidy box.
That's a great way to put it. And what's fascinating is that the benefit is fundamentally twofold.
Okay.
The first, and honestly the most critical reason anyone does this, is to get a lower overall cost. If that new consolidated loan has a significantly lower interest rate than the weighted average of all your old debts.
Like your credit card's at 25% and maybe a personal loan at 15%?
Exactly. Then that reduction in interest is the engine that drives all of the long-term savings.
Which means, at the end of the day, you're paying back less money in total, because less of your monthly payment is being eaten up by those interest fees.
Precisely. And then there's the second major benefit, which is just the sheer convenience factor. You go from juggling multiple creditors, multiple due dates, the 3rd of the month, the 15th, the 27th.
All the different terms and rules.
Yeah.
It's a nightmare to keep track of.
It is. And you move from that to servicing only a single loan. That administrative simplicity, it drastically reduces the chance of accidentally missing a payment, which is often what spirals a debtor into real trouble in the first place.
And while our main focus today, looking at the sources, is on individual consumer finance, the homeowner struggling with unexpected medical bills or that high-interest credit card debt, we should probably acknowledge that this concept exists on a much, much grander scale.
Absolutely. The principle isn't just for personal finance. The concept can also refer to these macro-level fiscal strategies.
Like for a whole country.
Or for major corporations. Think of a country taking an approach to consolidate corporate debt to stabilize its markets, or even restructuring its own sovereign government debt.
So a national government taking all these disparate debts owed to various international bondholders and just restructuring them under one new set of terms.
Exactly. The principle, one new obligation replacing many old ones, it stays the same, whether the debtor is you, a corporation, or a whole country.
But for our deep dive, we are focused squarely on how this impacts you, the individual consumer.
Right.
So before we can properly dive into the mechanics of getting that new loan, we really have to set the stage. We need to define the financial landscape that a debtor is even operating in. What are they actually consolidating?
We have to start with the basics. Just what is debt and what is interest? Debt, at its simplest, it's an obligation. It's money owed by one party, the debtor, to a second party, the creditor.
And it's never free.
Almost never. It's subject to repayments of the principal amount you borrowed, plus that fee for using the money, the interest.
So if the principal is the original chunk of money you borrowed, how is that fee the interest calculated, and why does it make things so difficult for consumers?
Well, the interest is the fee, and it's
Yeah.
typically calculated as a percentage of that principal sum per year. It's
Yeah.
your interest rate. And you pay it periodically, usually monthly.
Okay.
Now, where it gets tricky is when a consumer is carrying multiple debts, because then they're dealing with multiple streams of interest compounding at the same time.
So if you have 5 credit cards and they each have a 22% rate and 5 different minimum payments.
The total interest payment can feel absolutely crushing, and it leads very quickly to a situation where the debtor feels like they're only paying the interest and not making any real dent in the principal itself.
And this is where that big distinction, the one between secured and unsecured debt, becomes the absolute foundation of this whole conversation. It really dictates the risk and, by extension, the interest rate. Why is this difference so crucial?
Because the nature of the collateral, or lack thereof, it determines the lender's risk. And that risk is priced into your interest rate.
Okay, so let's break that down. Secured debt.
Secured debt means there is physical collateral, an asset like a house, a car, or even an investment property that the lender can legally seize and sell if you default on the loan.
They can just take it.
They can. And because their risk of losing money is so low, they can recover their funds from the asset, they offer much lower interest rates, maybe in the single digits.
And so, logically, unsecured debt is the opposite.
Exactly. Unsecured debt, like most credit card balances, medical bills, or short-term personal loans, has no physical collateral backing it up.
So what can the lender do if you stop paying?
Well, their only real recourse is to pursue legal action against you, to go after your future income or other assets. And that's costly, and it's really uncertain for them.
So to compensate for that much higher risk, they charge you a much higher interest rate.
A much higher rate, often in the double digits and sometimes, exceeding 30%. So consolidation, as we'll see, is often the process of converting that high interest, high risk, unsecured debt into a low interest secured risk.
And for the average consumer, what typically makes up that household debt load they might be looking to consolidate, we're talking about the high interest stuff they want to get rid of.
The specifics vary a bit by country, but the core consumer debt is usually made up of credit card debt, car loans, and sometimes personal installment loans.
Home loans are usually separate, right?
Right, the mortgage is its own thing. But if you add that core consumer debt to the mortgage, that creates the total household debt picture. For someone looking to consolidate, though, the credit cards are almost always priority number one because of those crippling interest rates.
And we really have to emphasize that critical subset of debt that's just exploded in importance over the last couple of decades, especially in the US and the UK. I'm talking about student loans.
Absolutely. Student loans can be an enormous portion of a person's total debt load, but they're regulated very differently than a standard car loan or credit card.
Why so different?
They often carry unique government guarantees, special tax treatment, and this is critical unique protections or restrictions when it comes to bankruptcy. That makes them a very distinct category that needs its own specialized consolidation approach.
So let's imagine our listener is carrying this heavy load. They've got those 25% credit cards, a car payment, maybe some old medical bills. When does this debt reach the point where they are actually looking for these kinds of drastic measures?
The need for structured relief, like consolidation, it typically comes up when a debtor moves from just having debt to being in a state of fiscal crisis. And that crisis point is generally defined by the danger of bankruptcy or insolvency.
Wait, let's pause right there because those two words, bankruptcy and insolvency, people use them interchangeably. But they are not the same thing, are they? We need a really clear distinction for you.
That's a great point. They're not the same. Insolvency is the state of being unable to pay your debts as they come due. It's an inability to meet your obligations. You might be technically insolvent long before you ever file for legal protection.
Okay, so it's a condition.
It's a condition. Bankruptcy, on the other hand, is the formal legal process under federal or national law where an insolvent person seeks relief from that condition. It involves a judge, courts, and either the liquidation of your assets, like a Chapter 7 in the U.S., or the creation of a structured repayment plan, like a Chapter 13.
So insolvency is the symptom and bankruptcy is the extreme judicial medicine.
That's a perfect way to put it. When the symptom insolvency becomes severe, consolidation is one of several paths you might take toward relief, hopefully to avoid that ultimate step of formal bankruptcy.
And it's so important to recognize that consolidation isn't the only option available here. What are the other alternatives people look at before, putting their house on the line?
Right. Aside from formal bankruptcy, there are three other major routes. First, you have credit counseling. This is usually from nonprofit or government-affiliated groups that help the debtor with budgeting and might offer a formal debt management plan, a DMP.
Now, what does that do?
It often involves the counselor negotiating a reduction in your interest rates with your creditors, but you don't take out a single new loan. It's more of a restructuring of terms.
Then you have the more aggressive negotiation tactics.
Right, that's debt settlement. This is where you, often through a third-party company, try to negotiate with your creditors to pay a reduced principal amount.
So you're basically saying, look, I can't pay you the full $10,000 I owe you, but I can give you $5,000 right now, and we call it even.
Exactly. And creditors sometimes agree because, $5,000 is a lot better than zero if you end up filing for bankruptcy. But this path can heavily, heavily damage your credit score.
And finally, the most desirable, though often policy-driven option, debt relief or forgiveness.
Yes. Debt relief is when part or all of an individual debt is just unilaterally forgiven. This often happens through government policy, think student loan forgiveness programs, or policy responses to major economic crises. The liability is just erased.
So let's pull this all together. When a person is approaching a fiscal emergency, they have this whole toolkit. They can negotiate down the principal, which is settlement.
Yeah.
They can try to get the debt erased, that's relief or forgiveness.
Right.
Or they can restructure it all into one new, hopefully cheaper loan, which is consolidation.
And often, the most efficient path is actually a combination of these. A debtor might seek settlement for some older, high-interest unsecured debt while consolidating a mix of smaller installment loans, all while maybe hoping for some government relief on their student loans.
So the decision to consolidate is highly strategic.
It has to be. It means you are confident you can handle one single new payment and that the terms of that new loan are truly sustainable for you in the long run.
That sets the stage perfectly. Now that we've established the why someone needs this breathing room, let's move into the how. Specifically, the mechanics of consolidation itself and the risk that comes with it.
So in the core process, that new loan is taken out to repay all those old high-interest obligations. The success hinges entirely on the new loan's terms being better.
And the most powerful tool for getting good terms is offering collateral.
Which brings us to secured consolidation.
And in consumer finance, when we say collateral, we are almost always talking about one thing, the home. Let's talk about the most common forms of secured consolidation that banks and lenders offer.
You typically see two main structures here, and both of them rely on the equity you've built up in your home. One is a consolidation loan that's secured as a second mortgage. The other is using a home equity line of credit, or a ALOC.
Okay, let's define that difference because it's so critical for you to know exactly what you're signing up for. What's the real difference between a second mortgage and an ALOC in this context?
A second mortgage is a standard installment loan. You get a lump sum of cash, usually all at once, and you use that immediately to pay off all your old credit cards and bills. It typically has a fixed interest rate and a fixed repayment schedule, say, for 15 years.
You get the money, you pay off the debt, and you start making one predictable new payment every month.
Exactly. A AELVs is fundamentally different. It's a revolving line of credit, more like a credit card, but it's secured by your home equity.
So you don't get all the money at once.
No, you're approved for a maximum amount, but you only borrow what you need when you need it. This can be useful if a debtor only wants to consolidate one or two debts now and maybe a third one 6 months later.
But there has to be a catch.
The catch is that AELOCs usually have variable interest rates. That means your payment and the total cost can fluctuate over time, which introduces a whole different kind of risk into your budget.
So the second mortgage gives you payment stability, but you take the whole lump sum immediately. The ELOC offers flexibility, but you're taking on interest rate variability. Either way, the basic requirement is the same.
Right. You have to put up your home as collateral, and the loan has to be less than your available equity.
And that home acts as the safety net for the lender.
Precisely. Which is why they can offer those tempting single-digit interest rates. But this leads us directly to the risk-reward balance, which is probably the most critical piece of insight for you.
So we're really talking about trading high interest on, say, $30,000 worth of credit card debt for the risk of losing your entire house, which could be worth 10 times that much. Is there any scenario where that trade-off is actually a good idea?
That is the core conflict of secured consolidation, and it's why it requires such careful thought. The trade-off can be worthwhile if two conditions are met.
Okay, what are they?
One, the debtor's financial behavior has fundamentally changed, and they are absolutely certain they will not just go and accrue new debt.
That's a big one.
The huge one. And two, the difference in the interest rate is so massive that the short-term cash flow relief it provides allows them to avoid imminent insolvency or bankruptcy.
Can you give me an example?
Sure. If you consolidate $50,000 in credit card debt at 25% down to a 7% second mortgage, the savings might be $10,000 a year in interest alone. That could be enough to stabilize your entire life. But yes, you are converting a financially painful risk, a bad credit score, into an existential risk homelessness if you fail to pay that secured loan.
Outside of the massive interest rate savings, you mentioned another potential advantage. A tax break in some countries.
Yeah.
Can you elaborate on the U.S. example?
Yes. Our sources specifically reference the U.S. tax code here. Generally, interest you pay on a mortgage, a secured debt against your main home, is tax deductible.
Yeah.
However, if you take out a secured consolidation loan like a second mortgage or a HELC, the rules for deductibility change based on what you use the money for.
So it's not automatic.
Not at all. The interest is only tax deductible if the funds are used to buy, build, or substantially improve the home itself.
So if I consolidated $50,000 in credit card debt that I use for, say, vacations and clothes, the interest on that new second mortgage is not deductible under current rules.
Correct, in most cases. If you use the loan purely for consumer purposes, paying off old credit cards, that interest is generally not deductible. There have been some specific legislative exceptions in the past for troubled homeowners, but the primary incentive has been limited.
So you really have to understand the specific current tax law because that perceived benefit might not even be there.
It could evaporate completely.
That adds another layer of complexity. Now, since we've established the risk of losing your house as the big downside, let's talk about the financial fine print that often makes the deal less attractive than it seems. The hidden costs.
Absolutely. Consolidation loans, especially the secured ones, aren't just about interest. They come with several major costs that reduce the immediate benefit. We're talking about standard administrative fees, the interest rate itself, and critically, something called points.
Points. Let's demystify that immediately. In simple terms, what exactly is a point?
In the lending world, a point is basically a prepaid interest charge or an origination fee. Specifically, 1 point is equal to 1% of the total amount you borrow.
So if I borrow $100,000 and a lender charges me 2 points, I owe them $2,000 right up front.
That's it. It's essentially an immediate, mandated down payment on the loan's interest.
And where does that money come from?
Well, these points are typically either paid in cash at closing or, more commonly, they're just rolled into the total loan amount.
Oh, so if they're rolled in, you're not paying interest on the points themselves.
You are. And they can significantly increase the initial cost of consolidation. If you're already in a financial crisis, coming up with that cash for points can be impossible.
This means you can't just look at the advertised interest rate, say 6%. You have to calculate the total cost of all the fees and points to determine the true annual percentage rate, the APR.
That is the crucial step. The APR legally has to reflect the total cost of borrowing, including those points and fees. A loan advertised at 6% interest with 3 points might actually have an APR closer to 6.5 or even 7%, depending on the loan term. If you fail to calculate this, you might realize the true savings are minimal.
Now, secured consolidation is the institutional gold standard because of that low risk for the lender. But what about the alternative? What if you don't have a house? Unsecured consolidation.
Right. Unsecured consolidation is another growing form of refinancing. Instead of demanding a house or car as collateral, a lender issues you a personal loan.
A loan that's big enough to pay off your other debts.
Exactly. It satisfies the outstanding consumer debt and creates one new loan on the lender's specific terms.
And since there's no collateral, these loans must rely entirely on your perceived trustworthiness, right? Your credit score.
They rely entirely on your creditworthiness, your score, your income, your debt-to-income ratio. And because they're unsecured, they carry higher interest rates than secured loans.
But hopefully still lower than credit cards.
Ideally, yes. The interest rate is still significantly lower than those punitive 25% rates you find on revolving credit card debt. Maybe it's 10 to 15%. So with this strategy, you eliminate the catastrophic risk of losing your home, and you trade it for a higher, but hopefully manageable, interest rate.
Now, moving from the regulated marketplace, we have to address the shadow side of this industry. Our sources warn that debt consolidation is sometimes offered by less scrupulous entities.
This is a major consumer danger. We're talking about loan sharks or predatory lenders who specifically target financially vulnerable people who are looking for consolidation. They charge these exorbitant, often illegal interest rates.
Hundreds of percent.
Sometimes, yes. And it traps clients in an even deeper, more inescapable cycle of debt than they started with.
And the very existence of this shadow market speaks to a failure in consumer protection, doesn't it? It prompts this discussion about the need for more regulation.
It absolutely does. When people are so desperate that they turn to non-traditional sources that operate outside of standard banking regulations, it highlights these deep systemic vulnerabilities. The discussion around more regulation often centers on capping interest rates or ensuring much greater transparency about fees and points to protect these debtors.
And finally, let's look at the professional infrastructure that's been built around this. What role do these professional debt relief and consolidation companies play? Because they don't always issue a new loan themselves.
Right. These firms, which include specialized private companies and even law firms, they act as these critical intermediaries. They don't always give you a consolidated loan. Sometimes what they offer is an administrative consolidation paired with debt settlement.
So the consumer makes one single monthly payment, but it goes to this company.
Exactly. They centralize the entire administrative burden for a debtor who might have, 7 different payments due on different days.
And the company then handles everything else.
The company then disperses that payment among the consumer's various creditors and manages all the communication and the negotiations. This simplifies the payment process dramatically. And while it's not technical consolidation by taking out a single new loan, it achieves that same goal of administrative simplicity. And it often includes aggressive debt settlement negotiation to reduce the principal you owe.
So whether you go for secured, unsecured, or this kind of third-party administrative help, the overarching lesson remains the same. The lower the interest rate, the higher the risk in terms of collateral.
And the more complicated the fine print.
The fees and the points. That brings us perfectly to the specialized case of student loans, where the rules of the game just change completely.
Yeah, if the consumer debt world is governed by collateral and credit scores, the student loan world is governed by government policy and, really, political philosophy. The key starting point for you to understand is that student loans are often regulated in a category that's completely separate from typical consumer debt.
Why are they in their own little box?
Because they represent an investment in human capital and education, and they're often guaranteed or subsidized by the state. This means the rules governing repayment, default, and consolidation are all tied up in public policy goals, not just pure banking risk management.
So let's start with the biggest and most formalized system, the United States Federal Direct Student Loan Program.
Okay. These are loans guaranteed by the U.S. government. For a debtor who has multiple federal loans taken out over 4 years of college, all with different rates, the federal consolidation process is purely mathematical. It's a restructuring, not collateral-based.
So how does it work?
When you consolidate federal loans, the Department of Education assigns a weighted average interest rate to the new loan. To calculate that, they multiply each loan's principal balance by its interest rate, they sum all those up, and then they divide by the total consolidated principal.
So that gives you the true average cost of all your debt. But the specific calculation detail here is fascinating. The weighted average is then rounded up to the nearest 1/8%. Why round up? Is that just administrative, or is there a revenue reason there?
It's primarily for administrative simplicity and standardization within the federal system. But yes, any rounding up mechanism naturally favors the creditor, which in this case is the government.
So by rounding up from, say, 5.10% to 5.125%, it's just a way to standardize things.
Right. It creates a standardized, slightly higher rate that simplifies billing and accounting for these massive loan portfolios. It's a very minor administrative cost that gets passed back to the borrower.
Okay, but here is the truly advantageous difference compared to the secured consolidation we were just talking about, the cost structure.
This is the critical advantage. Unlike private sector consolidation or getting a second mortgage, federal student loan consolidation does not incur any fees for the borrower.
Zero fees.
0 origination fees. 0 points. This eliminates a massive upfront cost barrier that plagues the traditional consumer lending market. The government's goal is administrative simplification and giving you access to new repayment plans, not extracting more upfront cash.
And we had that misnomer alert in the sources. We need to clarify for you. Federal student loan consolidation is not the same as refinancing.
That distinction is absolutely vital. The public uses the terms interchangeably, but they represent two completely different actions. Federal consolidation simply bundles your existing federal debt into one new federal loan. It averages the rate, and critically, it retains all your existing federal benefits, like access to income-driven repayment plans or public service loan forgiveness.
And private refinance.
Private refinancing is when you take out a completely new loan from a private lender, a bank or a credit union, to pay off your old federal and maybe private loans.
Why would you do that?
To get a new, lower interest rate based on your current excellent credit score and high income. However, in doing so, you surrender all of those federal protections and benefits. It's a permanent trade-off. Lower rate for higher risk.
That makes the choice agonizing. Do I give up my future safety net for a few percentage points of savings right now? That's a massive policy difference from the consumer market.
It raises the stakes significantly. Now, let's pivot and contrast this structured, fee-less federal system with the regulatory approach taken by another major economy, the United Kingdom.
Okay.
The UK system, especially their Plan 2 and Plan 4 loans, is built around a completely different repayment philosophy. It's focused on social investment and minimizing short-term personal risk. Loan entitlements are guaranteed, and the recovery uses the strict means-tested system based entirely on the student's current income.
Means tested, meaning the repayment amount depends entirely on how much you earn, right? So let's use a clear example. If I'm only earning, say, £15,000, do I pay nothing?
You pay nothing. For a Plan 2 loan in England and Wales, you only start making repayments once your salary goes over a specific threshold, which is currently £27,295 a year.
And if I get a big raise?
Then your payment goes up. If you earn £37,295, the difference is $10,000. And you're required to repay 9% of that excess amount. So your monthly payment would be a predictable £75.
That collection mechanism is perhaps the most unique aspect. How does the government ensure they get that money without you even having to remember a due date?
Repayments are deducted automatically, right from your salary, at the source, by your employer. It's done just like income tax and national insurance contributions. It's a statutory deduction, not a commercial debt payment.
So the debt is managed and collected before the money even hits your bank account. This structure seems incredibly protective of the debtor, which relates to the two major protections noted in our sources.
The protections are very comprehensive. UK student loans cannot be included in bankruptcy. That insulates them from the formal insolvency processes that your credit cards or a secured loan would face.
And the second protection?
Because the repayment is managed automatically through your job, the debt generally does not affect your credit rating. You're insulated from the private credit market's punitive measures.
So the system protects them from the student loan burden. But what's the pitfall that the sources identify?
The pitfall is that this very protection can create a false sense of security about financial literacy. Because the student loan is largely invisible and non-punitive, many students still struggle terribly with commercial debt, high-interest credit cards, overdrafts, personal loans, long after they've finished their courses. The system only addresses one type of debt,
Leaving you exposed to the risk of mismanaging traditional high-risk consumer debt. Okay, let's jump across the globe to Australia. This presents a fascinating evolution in enforcement philosophy, showing a definite move toward much harsher measures.
Australia's system has gone through a radical transformation. Historically, it was incredibly generous. It recognized that early career earnings were low. The system once allowed borrowers up to 35 years, more than an entire working life, to pay back their HELP loans.
35 years, that's almost generational.
It was, but our sources indicate that repayment window has been tightened considerably.
How much?
In some circumstances, it's been shortened to a mere 15 years. That puts immense pressure on debtors to accelerate their payments. It's a massive policy shift that acknowledges the rising cost of the program and demands faster recovery from graduates.
And the harshest consequence that the sources noted is truly jarring. It shows a commitment to enforcement that is unparalleled globally.
This is the most extreme point. Those who are seriously delinquent on their student loans, meaning they've shown a willful refusal to pay when they are able to, they face the possibility of being arrested at the border.
Arrested at the border over a student loan. How is that even legally possible?
It's based on the statutory right of the Commonwealth to demand payment from those seeking to avoid their obligations. It's a coercive measure designed to ensure compliance. It treats the debt not just as a financial obligation, but as a societal contract that must be vigorously enforced.
It moves the consequence from a bad credit rating to a restriction on your personal liberty.
Right. It starkly highlights the divergence in global debt philosophies, from the UK's protective and visible deduction to Australia's punitive, highly visible enforcement.
Finally, let's look at Japan, which has taken a unique, proactive approach focused entirely on prevention in response to rising arrears.
Japan recognized that arrears late or missed payments were climbing, and that signaled future default risks. Their response was not to punish debtors after the fact, but to tighten the lending criteria right at the point of application.
What specific preventative policy are they using?
Japan has begun associating loan approvals directly to academic performance. They're vetting applicants not just for financial need, but for their likelihood of successful repayment based on their academic diligence.
How does that actually work in practice? Are they saying if you get a C average, you can't get a loan?
The logic is that academic performance is a strong proxy for persistence and future success. If a student is consistently underperforming or shows low engagement, they are statistically less likely to graduate, less likely to get the high-paying job needed for timely repayment, and thus they present a higher default risk to the state.
So by linking loan determination to grades, they're using their lending power to influence academic compliance and filtering out high-risk applicants before the debt is even created.
That's it. It's a profoundly different policy goal. It shifts the regulatory focus from managing debt recovery to managing debt creation.
Exactly. When you look at these four systems, the U.S. consolidation with its weighted average and no fees,
The UK salary deduction that protects your credit,
Australia's border arrest risk, and Japan's academic linkage.
you realize that student loan debt is a political product, not just a financial one. Its structure reflects these deep national values about education, personal responsibility, and the role of the state in all of this.
The regulatory framework literally determines whether your primary anxiety is losing your house, ruining your credit, being able to travel, or just maintaining good grades. That sheer massive variation is truly the most significant takeaway from this entire deep dive.
It really is.
That was an incredibly dense and essential deep dive, covering the treacherous waters of consumer consolidation, the risk of collateral, all those hidden costs, and the astonishing global differences in managing student debt. Let's synthesize the key takeaways for you.
I think the critical synthesis points are these. First, debt consolidation is a strategic refinancing tool. It's built on administrative convenience and the promise of a lower interest rate.
But second, that trade-off is absolutely central. If you choose secured consolidation, you're trading your unsecured high-interest debt for lower interest debt, but you introduce that significant existential risk of collateral seizure, often involving your home.
And you must never, ever overlook the fine print of the costs, specifically those points, where 1 point equals 1% of the borrowed amount. It raises your effective cost, the APR, dramatically, and it diminishes your savings.
Third, the student loan environment is a realm unto itself. The U.S. government offers consolidation without fees, while other nations use these entirely different powerful mechanisms.
Like the UK's mandatory salary deductions, Australia's punitive border enforcement to coerce payment, or Japan's preventative linkage to academic performance to filter out applicants.
So what does this all mean for anyone who is actually considering consolidation?
It means that consolidation is not debt forgiveness, it's debt restructuring. It is a powerful tool, but it has to be entered into with absolute certainty about your budget and your behavior. You have to calculate whether the convenience and lower interest rate are truly worth the increased risk, especially if collateral is involved.
I think the greatest financial error someone could make is to consolidate debt, pay all the fees and points, and then immediately run up new high-interest debt on those now cleared credit cards.
It happens all the time. Consolidation has to be the last step in a comprehensive change in your fiscal behavior, not the first.
And as we close out this deep dive, we want to leave you with a final provocative thought to consider and explore further. We touched briefly at the very start about how this concept of consolidation can apply not just to individual debt, but to massive corporate or even government debt restructuring.
Right, and we've just seen how drastically different countries regulate consumer debt, particularly student loans, with these models that range from strict salary deductions to border arrests and academic linkage.
So given these varied, powerful, and often extreme national models of individual debt management models designed to protect taxpayers or ensure repayment or prevent default, how might the success or failure of these consumer approaches inform a country's larger fiscal strategy?
Especially when you consider the global trend toward corporate or governmental debt consolidation. Is the national lesson learned from regulating an individual debtor transferable to regulating massive national or global risk?
Think about that trade-off: risk versus reward, protection versus enforcement. Until the next time we dive in.